The minute you open the doors to open a business, you should be planning your exit. You just can't be the solo person and expect to get a massive payout. You got to build a company, and building a company takes years and years and years of planning.
Just think about your business always for sale, even if you're not planning on it. People who are successful, they have a plan, they're diversified, or at least a strategy to get diversified, which is what we'll get into.
I don't think the education system between high school and college, people really don't understand what money is.
When you go to Vegas, you start off with the red chips, and by the time you're done, you're dropping black chips 3 days later without even thinking about it.
Well, I think a lot of people are lost right now when it comes to money.
You know, $2, $3, $4 million, everyone's making a good living. They don't realize that they could increase the value of that business $300,000, $400,000, $500,000, $1 million if they would just get something as simple as the database under control. So if you could go back and give your younger self financial advice, what would it be? Welcome to today's PlanAssist Podcast. As those of you who listen to our podcast regularly know, it's really built to help people make better financial decisions. And we use 3 core principles to do that. Have a plan, be diversified, seek counsel. And on these podcasts, what we'll do is interview and have conversations with people who have successfully accumulated a huge amount of money and or experts in a particular field when it comes to helping you make financial decisions. Today, I'm super excited to have Russell Cohen. He's the president of South Florida M&A Advisors, and that's one of Florida's most accomplished merger and acquisition professionals. For more than 25 years, he's helped small businesses, and he's done it with over 600, almost $180 million in sales. He's helped owners navigate some of the most complex financial decisions you'll face. So those of you who have sold your business, you know this is a really tough process to go through. And even if you haven't done it, you're thinking about it. His team specializes in lower to mid-market transactions, brings structure, confidential, and trust to every deal. Under his leadership, South Florida M&A has been recognized as one of the top offices in the U.S. when it comes to M&A deals. He holds advanced degrees, and today, what we're going to talk about is primarily, though we'll touch on all 3 of the principles, I think today's conversation will primarily be focused on those people who own small businesses and are figuring out how do you get more concentrated as you get closer and closer to retirement, and how do you start kind of building that out. So we'll get into a really good conversation with that. So with that, did you want to add anything to that, Russell? Did I miss anything?
Yeah, thank you for having me on. I would like to update my resume. It might have been an outdated.
I just took LinkedIn. I was off.
Okay. Then I need to update LinkedIn.
Yeah.
We've done about 750 transactions, sales since 1999, and we're over 350 million. So I need to get that LinkedIn updated. So my apologies.
That's awesome. Good deal. All right. So I always start these podcasts out with the same exact question. So if you could go back and give your younger self financial advice, what would it be?
That's a great question. You know, I would say go and talk to my younger self to really learn about money. I don't think the education system between high school and college, people really don't understand what money is. We are starting to see inflation, in our economy that we have never seen before. And I just think people really don't understand their own financial system, the Western financial system. Once you really understand money, it will give you complete clarity and it will give you back the control. I think a lot of people are lost right now when it comes to money because I think it's a very manipulated economy right now. And we're facing huge inflation. And I think we're not really being told the truth about what's really going on in the United States.
Yeah.
So I think people really need to start take the education about money, understand the financial system that we're in, and really learn how money is printed. That's important. That will give you clarity on really what's going on.
Yeah, that's a really good answer. And it's a good place to start the conversation because that's the reason what happened. How I came up with those 3 principles was I started Core Wealth Consultants in 2012. And it became really apparent that I needed to come up with some simple, straightforward principles that I could share with clients when it comes to helping them make better financial decisions and kind of understanding money, basically, right? And so when I looked at people who were really successful, I found 5 or 6 or 7 principles that were common across them. And then I did what Charlie Munger suggests is to invert everything. So what would people who are totally unsuccessful or have chaos, financial chaos in their lives not do? And that's kind of how I bumped into these 3 principles because People who are successful, they have a plan, they're diversified, or at least a strategy to get diversified, which is what we'll get into. And then they're really, really good at seeking counsel. And that doesn't mean sitting down with some salesperson. That means getting input from a variety of different sources. And it includes kind of everything from professionals to just what's your opinion on something, right? And then I looked at people who are really unsuccessful, and they pretty much don't do any of that. And primarily is because they don't understand money. That's really what it comes down to. They just have a really hard time kind of starting, which we can start this conversation with a plan. Like if someone's going to sell their business, it has to start with what's the plan. And when I say a plan, I'm not just talking about some 50-page document. I see it more as if you're going to do an extension on your home or build a house, you've got to start with an architect, an engineer plan. That doesn't mean that that's the plan that you're going to look at every single day. Then you need to break that down into, okay, what are the two or three things we need to do this week, this month, this quarter, right? That's more what I'm talking about when I say a plan. What's kind of your opinion, or what do you see when you work with clients on that?
Yeah, I mean, a lot small businesses, and we're talking under the 5 million enterprise value, typically really do not plan.
That's right.
I come into situations and I'm trying to pick up the pieces. There's lots of holes, and either they're not ready to go to the market or they have to plug up the holes. The larger companies that we're dealing with, a little more sophisticated seller has made the investments in the accounting. They might have some business coaches. They are the elite businesses out there, that because if you're going to be bought up by private equity, these are professional buyers, they're professional accounting firms coming in, professional legal firms. You have to have everything lined up perfectly for that to happen. So in my world, of the smaller businesses do not plan, the larger businesses have been making the investments in the coaches, or they've had circumstances that woke them up and then they really got on their game in preparation for sale. So when we're dealing with the larger companies, there has to be structure in place. You can't be the legend in your own business, because no matter what, you're going to be staying on for a year or two to transition. But there's got to be, you just can't be the solo person and expect to get a massive payout. You got to build a company, and building a company takes years and years and years of planning.
And they have to have little stuff. I get into some conversation with some of my clients that have sold it, and I'll be curious to see what you do. This is if you're just running a little small business, 3 million, and that's not small, but it's a huge amount of money to them, but it's small in the business perspective. 2, 3, $4 million. Everyone's making a good living. They don't realize that they could increase the value of that business three, four, 500,000, $1 million if they would just get something as simple as the database under control, right? I mean, they don't realize how sophisticated these people are. When they come in, they're not just looking at revenue. They're looking at who are your clients, how long have they been, how much revenue comes from each, all that, right?
Yeah, I mean, a lot of business owners hit a wall where they've taken it as far as they can take it, and they either stay at that level or decline, or they need to bring in expertise. They need to bring in a business coach to break through that wall to get to the next level. And a lot of business owners don't do that because it is expensive to hire a coach. Even the best golfers have coaches, and so it
But
makes a lot of sense.
but the challenge I've always had with coaches, so I spent a bunch of years. I started out as a commodity trader and then went into executive leadership and all that stuff. So when I started Core Wealth, the one challenge I've always had with coaches is it's not that they don't give me good advice. This goes to my seek counsel piece. It's it's a lot of times I don't need the advice as much as I need someone to help me do something, right? Where those coaches more just give me a list of to-dos.
Yeah, it's an accountability.
Yeah,
They're going to tell you how to get there, but you have to be held accountable to do the work. They're not going to do the work for you. They're not going to hire the people for you. You got to hire the right talent if you're going to grow, right? And
that's a good point. Right.
you got to be willing to take some risk on working capital to grow. So you're digging into personal guarantees or lines of credits and everything like that. So, when you get to the private equity stage where that's your buyer, that's where the growth really can really take off, because they're trying to fuel the growth. But a lot of business owners just really kind of hit that wall because they don't want to take that next level risk of growing, and maybe may not be able to implement that plan.
Now, so when I sit down with a private equity person, have you ever seen deals where someone could just sell 49% to private equities, or do they always want control? Right. I mean,
Um, yeah, I mean, listen, some private equities will do a minority recap, and most of them want to do majority recap. So you got to really define what the owner's looking for, you
yeah,
know. So a lot of times a minority recap will work because they're investing in the company, and you get the advantage of the private equity consulting and everything of that nature, but the owner maintains control. But on the flip side, if you're 65 and you're at that end of the life of the business cycle. You might have a couple of years left in the tank to do that 2-year employment agreement, but you want that 80% cash out position with a carrot, let's say some rollover equity, where you can get a second bite of the apple and get even a bigger piece than you got on the first sale. Then it's a great incentive. Sometimes generational money can be made if the EBITDA is large enough. You could change many generations' lives with this sale.
Yeah, that's true. And I've seen that. I actually have some clients that are part of that, where, yeah, I mean, it's shocking how much money, but their egos have to get, I mean, if you've been successful, built your business, it's very difficult to kind of set the pride and ego aside, because when the private equity guys show up, they're there to make money. I mean, they're not there to.
Yeah, they need a return on investment for their clients, and
Exactly.
it's a 7-year hold, and they're going to flip the fund down the line.
Right.
But if you're in your retirement age and you want to see your wife or spouse is bothering you to start traveling and start really enjoying life because you just spent your entire life working, you have to have an exit plan, because no one you may not have family members capable of taking on the monster you built. Sometimes it's okay to give it to employees or management if they can somehow, if you trust them enough and they're going to pay you out and you feel comfortable that way. You definitely don't want to, own the business past 70, because once you go past 70, you are the legend in your own business and you're running a risk of a declining trend because of lack of enthusiasm. And then the worst is if you don't want to pass away while you're running, while you're, then you pass it on to your wife, and your wife doesn't really want to do what you did, and
And not even
keep going.
capable of it. I mean,
Right.
people don't realize there's just so many.
Wife or husband taking over the spouse business
Yeah,
doesn't
no,
make a difference.
not.
That was that particular person's passion, may not be the other spouse's passion.
Yeah, exactly. So what size of business and timing? So if someone's got a business and they're mid 50s, maybe they're not ready to sell, at what point do they reach out to you or someone like you and start thinking about how they might transition and getting ideas on transition? Because you'd help them with the transition to an employee-owned business as well, right? Or just to the PE guys?
Yeah, I mean, we typically work with strategic buyers or private
I see.
equity.
Okay.
So yeah, I mean, listen, you want to be like 3 to 5 years in advance so I can see what's going on, if there's issues, and make recommendations, and see if your accounting is strong. If what are the holes in the business, if there's client concentration, or all different stuff like that. Because when an attorney firm or high-powered accounting firm is looking at everything, their job is to unturn everything about the business, make sure they protect their rear end. So they're going to do a colonoscopy. I call it a colonoscopy on your business. So they're trying to find the holes. So if you're planning well in advance, then you can plug up those holes for the private equity and for the attorney side. And like I said, there could be holes in insurance, there could be holes in environmental, there could be holes in human resources, there could be legal holes, just all depends. So it's important that you plan well in advance, and you're going to build your team. You're going to build your M&A advisor. You should have an M&A attorney. You should have your financial planner. All right, because that's very important. What are you gonna do with the money after the fact? Other consultants could be your business coach. You could be a regular insurance person. So you want to have a very strong team that's all working together. We also bring in CFOs, fractional CFOs, because a lot of times the CPAs do not want to have anything to do with the deal until the very end. So a fractional CFO is heavily involved in the networking, capital analysis, and cleaning up their books so they are as close to gap ready as possible for the private equity group. So yeah, a lot of times the CPAs do not want to do the grunt work in the M&A transaction.
I could see that. I could really see that being the case. I mean, because that's so much work. But everything you just talked about, boy, would that make that company a much better company? Even going through the exercise of kind of identifying, well, what would it be to sell? I
Yeah, I mean,
mean,
if a seller
you,
made the investment and got a quality earnings in advance,
uh-huh,
meaning they went out and hired an accounting firm that did a quality of earnings, they can get like a 0.5 to 1x more on their business. And the investment could be 25 grand. And if you're making $3 million a year, you can get one more turn of $3 million. Well, that's not a bad return for 25 grand, right? Or 50 grand for a
that's
quality.
right.
You could do a light quality of earnings, and that report can be given to the private equity, and you've taken a lot off their plate, and you can get a better, like I said, a better, incredible return on that
But
investment.
so this is where I think people are really challenged, and this goes to how you started this conversation. Is people people have to understand money, and money has a bunch of aspects to it, right? So it also has an emotional side to it. It has a what's real money, kind of what's the real return, and then it just has this kind of real life money, right? What I run into is if I sit down with a client who's invested for 20 or 25 years, it's really easy. I mean, it's ridiculously simple to help those clients because they've been through 5 or 6 market cycles. They don't really see the markets as risky. They just see it as volatile, right? And that sounds minor, but it's a massive difference. When someone gets a big payout on something, that client's much more difficult because they take money and equate it to worldly things, right? So they'll say, using your example, going to cost you 50 grand to go hire a really good partial CFO, right? Well, they attach that to I can buy a car for $50,000, right? So they got to quit connecting those. Like it's kind of I hate using this analogy, but it's true. Is when you go to Vegas, you start off with the red chips, and by the time you're done, you're dropping black chips 3 days later without even thinking about it, right? And
Sure.
and Vegas does that on purpose. But that's true with people with money. They have to disconnect their investments and their financial decisions in their businesses with kind of their worldly. And of all the skill sets I see really rich people do, that's it. I mean, people just don't connect the two. They're really successful people.
A lot, all these business owners, they have this, the business has a value, and obviously it changes every year, and it's sitting on the balance sheet, but it's not liquid. So you have this incredible asset that's not liquid, and it's making money for you, it's supporting your lifestyle. But when you're in your 60s, you're looking to wind it down after a long career. You start seeing life after the business, and you're going to want to do things that you couldn't have done while you were working, 60 hours a week. So that's the job of the M&A. But we're going to make that business liquid to give to the financial planner to
It,
strategize to invest.
that's a
Now,
perfect way
obviously,
to
at
word it.
65 years old, you're not going to have the same risk tolerance that you were at 40 because you spent all these years building up this asset. And if there's a mistake along the way, you don't have that runway to wait for the next cycle. So it's probably going to be a little more conservative investments if you're getting out between 65 and 70. But it is the only way to take that asset that is on the balance sheet, not liquid, turn it into a liquid situation, and really, like I always say, let's turn back the clock when you were 18, when you had no responsibilities and you were just having fun. But now you're 72, and now
Yeah,
you
that's a
have
great
money
example.
and but you're free. You don't have to answer emails. You don't have to answer phone calls to clients, vendors, employees, and we've taken the handcuffs off your life.
So 2 to 3 years, do you do the whole country? Or do you primarily
I try
focus
to
here
stay
in
in Florida.
Florida?
Yeah, I
Okay.
try to stay in Florida.
And there's plenty of businesses in Florida, for
Yeah,
God's
plenty of
sakes.
there's low-hanging fruit in South Florida. That's why I call it South Florida M&A. I do
Yeah.
I do go all over the state of Florida, and I do have a vertical in construction, but I could sell all different types of businesses.
Uh-huh. So 2 to 3 years, just to summarize, start thinking about it 2 to 3 years. But I think what I heard, and this goes to kind of my 3 principles, build a team is probably your first very most important step is put a team together of experts in each of the fields and start thinking about it from a 3, 5 year
And
perspective.
build great infrastructure within your company where if you could, have a one person below you that can step into your shoes, then when you're selling the business, that's what the private equity, they're looking for the next person to step into your shoes. After your 1 to 2 year employment agreement's over, even shorter, they might let you go even shorter. If you have that potential president in waiting, wow, you've done an incredible job. You're going to get great money for your business. You're going to be very attractive and, just don't have account concentration issues. You just got to have everything in a line to make everything work, you know?
So what about these small businesses? What I find is most of them are almost neurotic in secrecy, right? So they don't share information. So if you're running a small business and you got 30 employees, you're doing $3 million. To really do it right, you need to be pretty transparent, don't you? I mean, you can't really do it quietly and say, I'm not really going to tell. You almost got to, you may not have to tell the line workers or something like that, but there's probably a group of people that need to know that you're actually thinking about this, right?
Yeah, but I was selling a very large roofer as an example, and the one level below the president, the president of their divisions did know about it, or the CF the
And they,
CF company
yeah,
did know about it, So yes, key people will need to know about it because the private equity groups are going to get them involved and everything. And so yeah, so certain, the regular employees probably don't need to know about it, but the higher up in
Uh,
the organizational chart will probably be very involved because they're the next group to step in. So it's very, and smaller companies like a $3 million in revenue, the owner is the key person, probably doesn't have a lot of structure. Might be the husband and wife or the wife and the husband either way, and they might have good staff, but it may not have the levels of structure where it would flow for private equity. That's where you would find someone relocating into the area or someone within the area that's going to be a hands-on owner operator.
yeah. So what would be a typical private equity deal where they just come in and buy the whole thing out, I guess? So you just sit down. Are they interested in $1 million businesses, 5 million? What's kind of the
Yeah, so
sweet
there's
spot?
very good question there. So when a private equity fund will raise money, okay, that they need to deploy, so
Mhm.
that let's call it Fund One, okay, and they have to make the platform investment into an industry. So let's use construction, a plumbing company, and make it simple, okay? They have to make the first entry into the plumbing industry. For example, I'm selling a plumbing company now, and this private equity group this is their first entry into the plumbing field. So they buy this one, they give it a really nice multiple, and then they're going to do add-ons. And the add-ons are going to be smaller, and they'll be able to put them into the platform. And they got the major platform, they got the key cog,
Oh,
and
they get scalability. So they buy the
right.
big one and then they go
And then
buy the
they
smaller
buy the
ones, but they
smaller
have the
ones.
accounting and
Right.
all that stuff
And
already set up.
exactly. So, the larger private equity groups probably would want as a platform minimum 5 million plus, it could be as
Yeah.
high as you want it to be. And then smaller private equity groups might go a little smaller, maybe like the 3.5 million for a platform, let's say. But once they make that first initial, they're going to start adding on companies into it, and that will become that fund one. That's fund one, number one.
Oh,
And
interesting.
they got their plumber, and they're buying 20 more plumbers, and
And
this
then
is
those other
plumbing.
plumbers, and I don't mean to interrupt, but I want to. So then those other plumbers, they could just be $500,000 plumbing if they're good businesses.
Yeah,
And
they want to, the private equity groups, they typically want to see like a 2 million EBITDA as kind of
right,
like a baseline. Now,
okay,
it would have to be real
clean.
special for them to go below 2 million,
I got it.
or a specialty industry that they feel like SaaS, where it's recurring revenue. They'll buy those all the time. So yeah, so that's what really going on. As a M&A advisor, the better multiples to be the platform. But a lot of times they've already made that initial investment, and
And
this
then you just
multiple is
plug
already
into theirs.
it
So,
plugs in, right. And then, 7 to 10 years later, they'll sell the fund. And that's where that rollover equity is where you can get a second bite of the apple and get a really bigger of the sale because they're selling it for a bigger multiple.
right, because and so that happens in my business too. So there's M&As that are buying these RIAs all over the place. So I have a couple really good friends actually that are running these RIAs that'll have $3-4 billion. They're the base, aren't they? And then they're coming out and saying, "Hey Tim, you want to roll into ours?"
Right.
And then you just take their processes, right? So you use their
And, it's
clearing,
just how much
their
money are they giving you down? That's really it comes down to.
exactly.
So
But
you
they
can
can
just
make
roll in
money
100%
fast,
of your business. You built this business over 20, 30 years. You're just not going to turn it over as no money down.
right?
So we have to get enough money up front, because there'll be capital gains of 20%. There'll be an Obama tax. There's a small Obama tax. There's a commission and an attorney bill. When you unpeel the onion, I always say it has to be enough out there,
Everyone
that
pays.
you're happy with what you're getting at the closing table. If you're not smiling at the closing table, I didn't do the right job for you because you're going to drop the deal because you didn't get enough money.
And if you want to get a sense of what your business will look like a couple years after the sale, all you have to do is look at the core company that you're merging into, right? Like what accounting systems are they using? What's their sales process? Who's their primary clients? It's going to be pretty predictable because in my business, we all have, like have a plan B diversified seed counsel. Everyone else they all have 3 or 4 core principles. But if I get merged into one of these bigger investment firms, they'll throw out mine and just adopt theirs.
So they're going to let you run the company exactly the way you want. But they want to grow it. So that's where they're coming in. They're going to help you with human resourcing. They're going
I
to get,
see.
they're going to streamline the processes that are going on in your a lot of companies sometimes antiquated. They're not maybe using technology to the best of the ability. So they're going to make sure that all the processes of how you handle each sale of what you're selling is more streamlined. Human resourcing benefits, let's
Efficient.
call it.
Yeah.
Yeah, I mean it's the buying power of many groups.
That was
So yeah,
very
so
interesting.
there is an advantage, but you got to be ready for it, because if you own your own business, you're the boss. And when you sell the business and you're an employee for 2 years, you are now part of a corporate structure and you're now part of a team. So that's a big step for an entrepreneur to do that.
Right. And that's why hiring someone like you is such an important part of the step, because you help them understand and get the perspective and be prepared for, right? I mean, it's not nothing should be a
It's a very
surprise.
complicated sale. So you need an M&A advisor kind of to kind of tell you where you're going and what to expect next and what are the hurdles to get the deal done. What you'll see in the LOI, what you'll see in the asset purchase agreement, what you're going to go through in the quality of earnings. It's a very detailed, overwhelming process that
Yeah.
I don't think most people would want to go through it twice because it just sucks up your time. You're trying to run a company, you're trying to keep the EBITDA as high as possible while this process is going on that's sucking you dry of all the information about your company, and you're working off a letter of intent, which is binding to the effect of that they're going to want to buy your company, but you're not really signing a contract until the closing. So technically, you could pull out. You wake up and you don't feel like selling, you could actually pull out of the LOI.
Does that
Uh,
happen very often?
but, it can happen. Yeah, sure. Why not? People wake up and think, I don't want to sell my company.
So
And yeah.
what's the typical, to kind of get to the, because I don't want to kind of just keep asking same questions, but I want to kind of do, what's the typical time frame a client should think about if they're selling their business, kind of 3 to 5 years? Then they engage with someone like you. You go find one of those private equity firms that's building that fund one, fund two, and they're doing the plumbers. You're going to be a third or fourth plumbing company. From the time they engage with this new PE firm to when you close, what's the time frame? Like a real estate deal, it's 3 months, right? It's two to
I would
three
say about a
months.
year. So
Wow.
let's say it takes about 90 to 120 days to get under an LOI, and then welcome to the welcome to the M&A process where, like I said, the colonoscopy begins. And that
Uh,
could be, everyone's going to say we're going to do it real quick, 3 or 4 months, 5 months. Things happen in the deal. Like I said, depending on the team you got, depending on what attorney you're hiring, if they're not a specialty M&A attorney and you got the wrong attorney that is fighting over points that are not, like I said, you're dealing with on their side, everyone, they got their team lined up with the accounting and the legal team. And if you got the wrong advisors, from an accounting and legal, it could just really delay the whole
yeah,
process.
because they end up fighting over stuff that's irrelevant, right? I mean, all of
Yeah.
a sudden it becomes like a discussion about something, and you're on the sideline saying, you realize this is like a rounding error in this deal, and here we are spending a month getting everyone wound up.
Yeah, I always say if you have a heart problem, you don't go to a podiatrist. So if you're going to have a very large M&A deal, hire an M&A attorney, and we work with many high quality M&A attorneys in South Florida that can go to battle for you. They're going to represent you,
Right.
but most important is they know the language, they know what's right and what's wrong, they know how to work the agreement and what the contract should entail. If you have someone that is a personal injury attorney, you're dead in the water.
And you got to keep it moving along. So when I started this conversation with a plan, I explained to people, when I say have a plan, I don't mean this 45-page PDF document that you just take and drop in a document. It's not that you may not get a document like that, but that becomes your reference point. What you have to really focus on, just like if you're building a house, is okay, this next week, we're going to get the foundation in, and here's the things that go with that. And then the people that you're going to have involved in that are all designed around keeping that process moving forward and getting the foundation in. And if you get the wrong people, all of a sudden you can waste a week, 2 weeks, 3 weeks over stuff that's kind of irrelevant, right?
The minute you open the doors to open a business, you should be planning your exit. If you take that direction from
Oh, that's a
day one,
good.
if you take that direction of, like I said, try to remove yourself as Superman, the legend in the business, and you're always preparing your business for sale from day one, okay? And you have that mindset to put money into accounting, make sure the books are accurate. A lot of people, I see many sellers who want to pay as little taxes as possible, so they'll take the last quarter sales and they'll hold it back and they'll put it in January and they'll pay all the expenses in upfront in December to make their tax circumstances. When we're dealing with private equity, we're dealing with an accrual accounting, okay? And the private equity groups are working off a gap accounting, and you're not working off gap accounting. So that's where we bring in the CFOs to try to get you as close to gap accounting as possible, so the private equity group can really understand what your business is all about. But if you take the approach from day one, when you open your business, is prepare for sale, then when you get to that moment in time, 10, 15, 20 years later, you're the winner. You're going to win. You're going to get an incredible lump sum of money. Sometimes it's a bonus at the end of the ride. Sometimes it's generational money. When we sold the roofing company for $100 million, That's generational money. He has set up his family for
And
generations.
generations. Yeah. So I think that is the best advice that I hope everyone kind of thinks about is think about your business always for sale, even if you're not planning on it, because if you do that, it'll cause you to take action. I had a coach back when I was working at Charles Schwab and Company. I actually hired a coach to help me kind of get promoted and go through the ranks at Schwab. This goes back to the 90s, so it looks different today. But one of the things that was incredibly valuable advice to me, and I did follow it, was he said, listen, he goes, the best thing you can do is quit worrying about what'll cause Schwab to give you a promotion and start thinking about what would cause Fidelity to hire you. Right. And he goes, if you go at it more like that, you will automatically get promoted. He goes, you will never, I never went to Fidelity, but I did look at what would Fidelity, if I went to go to work at Fidelity, one level up, what are the skill set, the recognition, the education that I would need to get hired at Fidelity? And to be honest with you, it was such a stress reliever because then I didn't worry about what my boss thought or what happened. I was just, what would I need to do and what skill sets would I need to get hired at Fidelity? And that's really exactly what you're talking about.
Yeah, I mean, if you're in your particular industry, whatever industry,
Yeah, it doesn't matter.
business owner in, try to become a leader in your industry. Get involved in your local association. Get to know the people in your marketplace. Become a leader in your vertical, let's call it, and you'll become a better business owner. Okay, you're going to learn best practices. Now, you never start as the president. You come in as a member, and you start making friends with people who are senior to you, 20, 30 years, and you'll be able to get their wisdom and learn what made them successful. And then 10, 15 years, you're the leader. You're now leading that association. Simple stuff like that. Just get involved, learn from the people that have 75,000 hours in your trade, and
Yeah.
and then learn from the experts, and then you will become the senior, just like I have when I started at 29, and now I'm 55. And so that's what it takes.
Well, and one of the challenges, those of you listening to this is if you're relatively young and you haven't had the training, I mean, executive coaching, et cetera, sometimes they think that is working with the competition when what you're talking about is not. It's being part of an associate. It's like me working with other financial advisors. That I don't see them, when I was young, I saw them more as competition. Today, I don't see them as competition at all. I mean, there's so many clients out there that one would like this person or one would like this person, but understanding what they're doing is very valuable and important for me to help my clients grow their wealth.
Yeah, so for me, like I'm a member of the M&A Source. I've been a member of that association of M&A advisors since 2017. I'm on the board of governors right now. I'm
Okay.
the membership chair for the United States for the M&A Source. And we're talking about 700 M&A advisors across the country. And I have two conferences I go to a year, and I get educated, get better educated, try to be
Yeah.
as expert as I can be in my fields. And if everyone took that approach into their industry, you'll have incredible knowledge, and you'll be able to run your business because there's always someone who does it better than you, and you'll be able to see their best practices.
Yes. That's fantastic. So to finish this up, is there any kind of suggestions or things you want to kind of touch on just to close it up? Because I really appreciate you taking the time. It's been important because I think for people who are thinking about selling, we touched on a couple points. And then also there was a couple really ahas for me. Like I want everyone to kind of take away, whether you're planning on selling your business or not, thinking about what would your business need to look like to sell it, would make it a better business.
No doubt. At this stage, depending on your age, if you are in the 60s, then you need to be really fast forward into the plan of where do you see your exit. That's immediate. That because it's coming right
Yeah,
around the
no,
corner,
yeah,
no doubt about it. But if you're in your 50s and 40s, the earning power is still there, and no amount of money is really going to probably unless it's an incredible opportunity. If you have earning power, then just continue what you're doing, build a structure, build a company that you feel that can be
sold.
transferable.
Yeah.
And like I said, put yourself around a team that will protect you, but also get you to the finish line, and also help you prosper. No doubt.
Yep, that's a great way to finish the call. So, well, with that, how do people get a hold of you? Give a summary of kind of, again, who you
Sure.
are, and they'll put that up on the website.
Yeah, southfloridamna.com is the
Uh-huh.
website. Russell Cohen, phone number 954-646-7651. Emails are cohen at southfloridama.com. So found very easily on the internet, South Florida M&A. And thank you for the opportunity to talk to you, Tim,
Oh,
today.
I appreciate it. Thank you so much, Russell. I appreciate it. It's a great call.
My
Thanks again.
pleasure.
Have a great day.
Thank you.